Hello, everyone. My name is Arina Surdu, and I will present this research on behalf of myself and my colleagues, Julio and Steve. And the title of the paper is What Happens Abroad Stays Abroad, Comparing the Reputation Erosion of MNE Irresponsibility in Home and Host Markets. So essentially, our question here is, how does public disclosure of corporate social irresponsibility influence M&E reputation? The reason why we look at M&E reputation is because we know both in management and in international business management that M&E reputation is an intangible assets, and a firm's reputation is a critical source of competitive advantage. And when harmed, of course, it can be a source of disadvantage and even threaten the survival of an organization. We know that investors may make decisions about investing in an organization or not based on that company's reputation and other intangible assets such as reputation. And the research rationale, of course, to do this research around this time is that multinational firms in particular are increasingly accused of behaving irresponsibly, both in their home markets, but particularly in their host markets. Classic example of this is firms locating global value chain activities in non-developed markets, whereby they have been accused of child labor, mistreating employees, poor working conditions, and so on. But we also have other types of irresponsibility, and we'll get to that later. But of course, we have oil spills, product harms, and so on, some more severe than others. Now, research has suggested that, and of course, the practical environment has suggested that public disclosure of corporate social responsibility will damage an M&E's reputation based firm-specific advantages. Now, what we do here is look at this relationship between irresponsibility and a firm's reputation and changing reputation through a behavioral lens. More specifically, we apply the behavioral perspective of egocentric biases in order to understand the extent to which CSI disclosures actually erode M&E reputation. And we have a longitudinal analysis with a sample of over 2,000 social irresponsibility events involving Fortune 500 firms, in particular US-based MNEs. And our research so far does confirm the strong influence of CSI location and CSI type on changes in M&E reputation. So in other words, where the social irresponsibility, the disclosure of social irresponsibility is associated with, and the type of social irresponsibility will have an impact on whether or not investors and industry analysts, which are our key stakeholders, will revise down the firm's reputation. And of course, this can have an impact on the firm's performance and stock market price. So our focus, and this is important, the focus here, the key stakeholder that we look at, because we measure reputation through Fortune 500 data, is the investor and industry analyst. And I will discuss later why this is important in terms of our results. Background to this is that we assume that competitive advantage in international markets depends on exploiting your FSAs or ownership advantages, and of course protecting them over time. These FSAs are a source of ownership advantage, and given their value, they should be protected and internalized by the firm. And of course, when firm-specific advantages are damaged or they're weakened, such as can be the case with the firm's reputation, firms are expected to reduce their commitment or do everything they can in order to protect these assets and avoid further damage. Now, recent calls for papers have suggested that actually we need to understand more about the circumstances that do erode reputation, particularly for a multinational firm. We need to understand more about the outcomes of social irresponsibility when disclosed in the media, when associated with certain types of firms. And here in particular, we have a very broad definition of corporate social irresponsibility. So we define it as the actions that result in potential disadvantages and or harms to other actors. Now, of course, these actors can be different stakeholders of the firm. It can be a firm's employees, customers, or of course, shareholders. Now, in line with this, we developed a series of hypotheses. Now, first of all, we use the egocentric bias, and this idea is something that has been discussed in international business or referred to as the home market bias. And we define it as the unconscious tendency of an individual to emphasize the importance of information relating to themselves. And this is something that everyone does when making decisions. Information related to themselves and their in-group members, and de-emphasize information that is not as critical to themselves. And this forms the basis for the theoretical development of our paper. And of course, we expect that this egocentric bias will influence the manner in which industry analysts and investors, which are a key stakeholder group, will revise down the reputation of the firm or not do so. Because instances of CSI may be perceived to pose a threat to the safety of the individuals or their in-group members, CSI that arises within the home market location, so in this case, the US, CSI that has been disclosed in association with harm brought to US stakeholders, will have a greater reputational impact because it is more likely to trigger these egocentric biases. Now, it's likely to trigger these egocentric biases because these biases perform an important cognitive role, which is to prioritize information that is most important for each individual at a given point in time. And this is, again, research that has been done in sociology and psychology, and these findings have been established for a long period of time. And this, of course, will have an impact on the manner in which our key stakeholder group interprets information about the disclosure of social irresponsibility events. So our first hypothesis and a key assumption in the paper is that there's a negative relationship between public disclosure of CSI and MNE reputation. And this relationship and this negative effect will be stronger if CSI arises in the home country. Secondly, we also know that egocentric biases manifest a bias of empathy towards those stakeholders harmed by CSI in markets that we perceive more similar to our own, such as, in this case, other Western markets. And these similarities can be in terms of institutions, culture, and views towards what is and what is not socially responsible. So we propose that egocentric biases extend beyond the individual's nuclear group, which is the host market, and will manifest themselves towards the extended group, which in this case is Western host markets. Now, again, there has been research on this suggesting, particularly in social identification theory, that has suggested that there are multiple layers in which individuals socially identify and make decisions in groups related to families, sports teams, brands, neighborhoods, nationalities, cultures, and so on, and prioritize information associated with that in-group when making decisions, exerting a certain level of bias. So our second hypothesis relates to the in-group of the firm. And we assume that the negative relationship between public disclosure, corporate social irresponsibility, and MNE reputation is stronger in Western host markets and weaker in non-Western host markets. Now, our conceptual model looks something like this. If we start with the left-hand side, we have the MNEs reputation assessors that would interpret information associated with the firm host market, which is Western or non-Western host markets, where the CSI event has been associated to occur, and of course the MNE's home market, where the focal CSI event has been associated with. Now, these focal CSI events will arise in particular location or particular settings. And what our assumption is that those that occur closer to home are most likely to have an impact on the manner in which these reputation assessors noticed information about the firm and interpret it and perceive it. Now, of course, the second stage is how the social irresponsibility event is perceived and interpreted. And what we assume that the effect on reputation will be exerted through the egocentric biases of these key stakeholders, as well as the type of the category of location where the event has taken place. So has the irresponsibility been disclosed in association with the home market or different host markets? And this is likely to influence whether or not this key stakeholder group will revise down the reputation of the firm year on year. Now, what we found so far has been very much in line with our hypotheses. So if we look at the variable here, which measures the total corporate social irresponsibility events associated with the home and host Western and non-Western markets, what we found in models 2 and 3 was that actually corporate irresponsibility has a negative effect on reputation when disclosed in association with the home market, and the effect is strong and highly significant, slightly less significant in association with the host Western market, and insignificant effect, although negative, in associated with host non-Western markets. Now, of course, one of the explanations for this is the fact that these assessors, and a particular group of assessors, have biases associated with the individuals harmed by a particular event according to the location in which this event has taken place. But the secondly, and also important, is because we look at a particular group of stakeholders, which is our investors or industry analysts, the type of CSI event will also matter. So we did some further analysis into this by looking at what we refer to as stakeholder-specific and non-stakeholder-specific corporate social irresponsibility. So research suggests that the type of irresponsibility that these stakeholders care mostly about would be competitive irresponsibility, management compensation, financial taxation, because these are industry analysts and investors. Whilst non-stakeholder specific CSI would be consumer, employee, environmental ethics, human rights, and public health type CSI events. Now, when actually looking at this, by also, of course, looking at the location, whether it was associated with the home market, host market, and non-Western host market, we found some mixed results. So if what we refer to as stakeholder-specific CSI, only financial CSI has a statistically significant effect. And in fact, what we found was that financial CSI is the only type of social irresponsibility category that will have an effect across all three locations. So we can see a negative effect for the home market, negative effect for the host, and negative and somewhat significant effect for the outgroup of the firm as well. So when it comes to financial corporate social irresponsibility, these stakeholders care irrespective of whether it is located. When we look at some of the other sources of irresponsibility, when it comes to the outgroup of the firm, we do see that they become less significant and even positive in certain instances. So these results overall do confirm that for MNEs, corporate behavior is only socially responsible to the extent that it is perceived as such. And that's why we would argue that more behavioral theory is needed to understand these types of decisions and how management perception has a massive impact on the reputation of the firm in this case. So theoretically, we aim to contribute to this literature by adding a behavioral lens to our understanding of how stakeholders perceive M&E behaviors. And of course, going back to a previous point, we have looked at a specific group of stakeholders, which is our industry analysts and our investors, but we could look at the perception of employees, of course, we could look at the perception of customers, depending on what type of firm we choose. So one is this idea that actually stakeholders do perceive M&E behaviors differently. And in this case, depending on the type of behavior, but also where it is located. Also may mean that reputation-based FSAs are not all that firm specific, but rather firm attributed, and they're not always owned or always controlled by the firm. And of course, looking at corporate social responsibility more broadly is one of these grand challenges that have been listed in the last few years because the social responsibility of the firm is so important. And of course, firms behaving responsibly is so important. So as we become more increasingly concerned with these challenges, we will also become more concerned with perception management challenges. So understanding the nature of such an important tangible assets and how it can lead to erosion of firm-specific assets is important. So thank you very much for listening.